Imagine this. You walk out of the store in 1971 with exactly $1 worth of stuff. Maybe that doesn't seem like a lot of stuff, but in 2014, if you were to walk out of the same store with the same stuff, it would now have cost you $5.86. Suddenly, that seems like more stuff. What this means is that if I took a dollar from the year 2014 and I tried to buy some 1971 money with it, my dollar would only buy me 17 cents in 1971 money. This problem of inflation is nothing new, but it has become a much larger issue since 1971. This year, 1971, is not chosen at random. It is the year during which the Bretton Woods system ended. The Bretton Woods system required the US dollar to be pegged to a certain weight in gold. This system came to an end in August of 1971 under President Nixon, and inflation has since spiraled out of control. The reason for this is that the end of Bretton Woods and the empowerment of the Federal Reserve has enabled the Fed to manipulate the money supply however they see fit. This has led to a devaluation of the dollar. The act of pegging currency to a commodity promotes stable money. It does not necessarily mean stable prices, but it does mean that our dollar will not lose purchasing power over time. A very common misconception about the gold standard is that it would be very difficult to return to, which is just not the case. A return to the gold standard would be very good for the United States and potentially the global economy, and it is a very feasible goal which we should look to achieve. Nathan Lewis said it best when he said, "You cannot have a gold standard system in the future if nobody knows how to do it." Before we try to understand the gold standard, let's first make sure we understand what money is. Now this sounds like a large undertaking, as complex as money is nowadays, but that's part of the problem. Money should be simple. In his book, Money, How the Destruction of the Dollar Threatens the Global Economy and What We Can Do About It, Steve Forbes lists the three main purposes of money. First, it is a measure of value. Second, it is an instrument of trust that permits transactions to take place between strangers. Third, it provides a system of communication throughout a society. Now, what this means is the following. Money is a measure of value, and nothing more. Forbes often draws the comparison between money and a ruler. Money tells us how much wealth we have, but does not create it, the same way that a ruler tells us how many inches we have, but can't create an inch. It also means that if you walk into a store and see something you want, you are trusting the money in your wallet will be able to purchase it for you. For instance, let's say you're a farmer and you grow corn. Your corn may not be accepted everywhere as a form of payment, but you can sell your corn for money, which you trust will be accepted everywhere as a form of payment. Lastly, money is a means of communication, whether you know it or not. If the price of something goes up, this tells us that the demand for that item is high. Likewise, if the price goes down, this tells us the demand is low. Money communicates like this every day, whether we know it or not. It should also be noted that it is for these three reasons that people invented money. The advantages of the second criteria are immediate. From the example given, it gives us something which we know will be accepted as a form of payment, and that is much more convenient than trying to find someone who wants your corn and also has something which you want in return. Now, as stated previously, stable money doesn't necessarily imply stable prices. The price of something depends on much more than whether or not we're operating under a stable form of currency. Stable money does have its virtues, though. For instance, if prices change because of the Federal Reserve's manipulation of the money supply, this produces false implications about the supply and demand of certain products. It is this sort of confusion that caused the housing bubble and subsequent crash of 2008. But if we're operating under a stable form of currency, we can rest assured knowing that price fluctuations accurately represent market trends. Unstable money rewards debtors and punishes people on fixed incomes, like retirees. Bill Tarrin found that his retirement account paid 0.4% interest during a period of inflation that was around 2.8% in 2012. Inflation is particularly punishing for people with fixed incomes like this. How does inflation reward debtors? Let's say I owe you $20,000, spread out over the next 10 years. But at the end of those 10 years, the dollar has depreciated substantially, so I'm paying you back with cheaper dollars. Yes, there are interest rates and things of that nature, but sometimes that's not enough. The biggest debtor of all is our government. If the dollar depreciates, the government is able to pay back bondholders with cheaper money. This promotes debt and allows the government to get away with their irresponsible spending habits. There are certainly other advantages to stable money and disadvantages to unstable money, which we'll discuss a bit later, but first, let's take a look at the history of the gold standard and the Bretton Woods system. There had certainly been currencies backed by gold long before the installment of the Bretton Woods system in 1944. For instance, In the late 1800s, most of the larger economies of the world adopted a gold standard after seeing the immense success of Great Britain after tying the pound to gold. In 1717, Isaac Newton fixed the pound to gold at the rate of 3 pounds, 17 shillings, and 10 1/2 pence to an ounce. This ratio would survive until 1931. From 1821 to 1914, the cost of living in Great Britain rose only 0.1% per year. Alexander Hamilton, our first Secretary of the Treasury, fixed the value of the dollar to gold. To be exact, the dollar was fixed at $19.39 per ounce of gold. So, many nations now off the gold standard, and the conclusion of World War II, many nations were left financially ruined. In an attempt to restore pre-war economic success, in July 1944, representatives from 44 different nations, the United States included, gathered in Bretton Woods, New Hampshire, to establish what would later be known as the Bretton Woods system, which required the US dollar to be pegged to a certain weight in gold, and then the remaining 43 nations would establish a flat exchange rate between the US dollar and their own, thereby fixing their currency to gold without even holding any of the precious metal themselves. The United States and the rest of the world enjoyed great economic stability under the Bretton Woods system until 1971, when Richard Nixon chose to put an end to Bretton Woods. Nixon had originally intended to temporarily suspend Bretton Woods out of fear that the dollar was overvalued following the Vietnam War. This began the modern era of fiat currency. What kind of toll has the fiat currency system had on the economy? As stated previously, the dollar in 1971, the end of Bretton Woods, had the same purchasing power as $5.86 in 2014. To be totally fair, $1 in 1944, at the beginning of Bretton Woods, had the same purchasing power as $2.30 in 1971. Some inflation still occurred during the Bretton Woods era, but when we compare that to the first 27 years after Bretton Woods to the 27 years during which the Bretton Woods system operated, we find that a dollar in 1971 had the same purchasing power as $4.02 in 1998. The degree of inflation almost doubled during the 27 years following Bretton Woods when compared with the 27 years during the Bretton Woods era. Now, I know what you're thinking. Prices have certainly gone up since 1971, but so have wages. This is a fact which I can't refute. But at what degree have each of these things increased? In 1970, minimum wage was $1.60 an hour. Today, it's $7.25 an hour. That's a 353% increase. This doesn't seem so bad. In fact, it seems good. But take the following into consideration. In January 1970, the Consumer Price Index was 37.8. In January 2011, it was 220.223, yielding a 482% increase. What this means is that for every dollar the minimum wage has gone up, prices have gone up $1.36. So even though we appear to be earning more money now than we were in 1970, prices have increased more than wages. Americans have had their suspicions about the Fed. Rasmussen Reports conducted a poll in 2013, and 74% of American adults were in favor of auditing the Federal Reserve and making the results public. Only 10% of people were opposed. The fact that people are having these concerns means something. With all that we know about economics, and the degree to which we continue to study it today, why hasn't the Federal Reserve's quantitative easing strategy produced results? Forbes puts it best when he says, "Seemingly sophisticated equations and various measures of money can never anticipate what people actually do." Quantitative easing is supposed to be a reaction to market trends that produces favorable economic results, but people are unpredictable. Attempting to keep the value of the dollar stable is a much more safe approach than trying to adjust the dollar's value based on economic trends. Money has been pegged to all sorts of commodities over the years: rice, corn, silver, gold, and much more. Why should we peg our currency to gold? The answer is simple. Nothing on earth has retained its value over the years like gold. Gold is virtually indestructible. All 6 billion ounces of gold that has been mined in human history is still in existence today, and it is estimated that more than 90% of it is accounted for. While there is probably still gold lying somewhere undiscovered, any discovery of gold wouldn't change the global value much. When Spain traveled to the New World and discovered massive amounts of gold, prices only fluctuated about 1.7%. Even more giant discoveries like the California gold rush never increased the supply by more than 5%, and even then the growth rate quickly returned to normal. So, while gold is subject to some fluctuation in price, the magnitude is small compared to the rate of inflation which we've experienced since the end of Bretton Woods. There are a lot of concerns that people have with gold. Probably the most common concern is that there's not enough gold. The Federal Reserve wouldn't actually need to hold enough gold to back every dollar currently in circulation, because while you could technically walk into a bank and exchange your dollar for gold, the assumption is that most people won't. Even if people did, there would be rules in place that would prevent this from becoming a real problem, which we'll talk about later. Some people argue that the price of gold has certainly increased over the years. While this is technically true, it is only so because the dollar has not been linked to gold. The price of gold hasn't changed. The value of the dollar has. Another concern is that such a fixed rate would restrict economic growth, which is downright outrageous. Forbes eloquently writes, "It does not restrict the supply of dollars any more than a foot with 12 inches restricts the number of rulers being used in the economy." There are many more concerns, most of which can be debunked almost immediately. I'm not claiming the gold standard is a perfect system which will cure all of our economic problems, but it will cure some. Until we find a totally perfect economic system, the gold standard is the next best thing. Steve Forbes lays out a plan for a modern-day gold standard in his book. It is as follows. The first step would be fixing the dollar to a certain weight in gold. Forbes suggests that this weight could be determined by taking a 5 or 10-year average in order to make sure we haven't got the current price of gold wrong. Even if we do, inflation would quickly come to a halt once the economy had stabilized. We could bring the program in gradually. That way businesses could prepare for the new economy, and a more natural price of gold could re-emerge. It is more likely than not that after fixing our dollar to gold, we would have a whole host of countries fixing their currency to the dollar. Like during Bretton Woods, this would result in flat exchange rates among the countries involved, and would keep Washington playing by the rules. We would still have the dollar-gold convertibility like we did during Bretton Woods. Someone could walk into a bank and exchange their dollars for gold. A rule would be in place so that if the government's gold supply fell below a certain number, they would have to replenish their supply. The only way this would happen is that if a lot of people were exchanging gold for dollars, and if that's the case, then the government would have a lot of dollars to buy more gold with. The Federal Reserve's purpose would be as a lender of last resort, and could assist with panics in the case of a national emergency. A plan such as this would virtually destroy inflation and would hold the government accountable. Today we've talked about just some of the advantages to stable money and the disadvantages to unstable money. We could go on and on about how stable money is better than unstable money, and a lot of people ask, if stable money is better, why are we currently operating under the fiat currency system? The answer is simple. Gresham's law. Bad money drives out good money. Over the course of history, we've abandoned the gold standard multiple times, but we've always returned to it. The return to the gold standard is near, and already has political backing. Congressman and presidential candidate Ron Paul and Congressman Ted Poe have already voiced their support for it, among many others. The age of the gold standard is coming, sooner or later, and it's important that you, the future of America, knows how to work it.